Welcome everyone, welcome back to Be Rich. I have Sashwath with me again today. I thought we'll do something interesting today and talk about different ways we can invest and earn some income from the investment. One of the biggest things is, yes, we always talk about investing, but we also do want some income. We don't want to wait off for some faraway date to spend the money which we're investing. It would be nice if we do get some monthly or yearly stipend from our investment. So with that in mind, I thought we'll pick Shashwath's brain on the different methods of investing and earning at the same time.
Yeah, so we can go over the basic
Correct.
asset classes.
Correct. The first one which we want to touch upon, which we'll never preach you to do it in this channel, but it's something which is there, which a lot of people do use, which is fixed deposits. A lot of people do fixed deposits. A fixed deposit is nothing but going to a bank and you give the banker your money, and he in turn enjoys your money on your account and he pays you a little bit to have fun with your money. In essence, that's what it is basically. But he gives you a paltry interest of 5%, 6%. Now that interest rates have been raised, maybe you get 7% or 8%. And he goes out and he lends it in the market or plays in the market, invests in the market, and he makes a better spread. He keeps a profit to himself and he gives you that small interest. But it is something that is asset class, investment class. It is very safe and secure in most cases if the bank is safe and secure, and you get your interest. Of course, we're not going to talk about tax on these things. Everything is taxable nowadays, including bonds. So we don't want to dive into taxation. But as an investment opportunity, fixed deposits is the first one which we thought we'll touch on. What do you think about fixed deposits, Sashwath?
So, I mean, you pretty much covered the most important point with fixed deposits. I mean, two most important. One, it doesn't give you the returns which you want it to. Considering that your inflation rate anywhere shoots up from 5 to 6% whenever it pleases. So you never wanted to sort of give you negative real return, because in the past 2 years we've had negative real returns with the inflation rate sky high, and now it's sort of taming down and you have higher returns on FDs. And it may make some sense to some people who want to just avoid all the other facets of investment by saying, I want my money in a bank, and I want it in a bank which I know is not going to fail. And that can be any one of your big
Government
banks.
banks, yeah.
Government banks, yeah, definitely. So that's one camp of thinking. So it's the idea that you want to minimize risk as much as possible. You're saying, no, I don't even want to look at government bonds. And that's considered the least risky asset. So you're saying, I don't want to do anything with all the technicalities of investment. I just want to put my money somewhere where I get some amount of money at the end of the year. That, for people who have a very low risk appetite, FDs are a great avenue for you to put your money into. But that being said, if you are not pleased with your returns from an FD, there are other avenues in which you can invest. And if you need your money in the short term, you can definitely put it in a short-term FD, and you can keep it there until you need access to it. That is something which we do quite often. There are periods in your investment cycle where you might want to keep the money parked for a few months, where you don't have anywhere to keep it and you don't want to commit to an asset. So you're saying, I want to keep money as money. That way, FDs may be something which people can look into. But as he said, it's the returns which it yields not very much. So most people, it's already out of their bucket list of investing.
True. The second one which you want to touch upon, which I'll let Shashwath explain a little further on, is equity and mutual funds, and how equity and mutual funds can be providing you yearly income as FD does.
Yeah. So when it comes to equities and mutual funds, we can separate the two into two asset classes, because your equity, when you look at equity, yes, mutual funds do invest in equity. But mutual funds are a bigger titan of itself, because you're not, some mutual funds say, I'm going to spread your risk and I'm going to buy different asset classes. So the thing with mutual funds you have to remember is that you want to go for a passively managed index fund or a passively managed debt fund. You do not want to buy an actively managed fund, number one. There are many reasons, and in this series of fundamentals of investing, we'll go into why passive funds are better than active funds. But in this video, for the sake of brevity, what we're going to be talking about are passively managed mutual funds. Passively managed mutual funds have one fund manager or two of them who basically only work on matching the index. So if the Nifty 50's proportion of stocks changes, if there is a more weightage given to a certain stock, the fund manager's only job is to match that. So what you're doing by investing in a mutual fund is you're buying a piece of India. You're buying a cross section of India. You're saying if you believe in India's growth and you believe in India's growth story, then you can very happily buy a passively managed index fund with low costs, and you can put your money there and forget it for the next 10 years, and you can set it up as an SIP. And an SIP is known as a systematic investment plan. So you can set it up in such a way that you can forget about it. Every month when your salary comes in, you can set it up so that a part of that goes into your mutual fund. You can close your eyes and you don't have to think about it. So you are making a bet on India with mutual funds. The only thing with mutual funds I will say is that there's a growth option and then there's a dividend option. And depending on your taxes and your income, one option may be better than the other. And when we make a video on taxation, we'll cover that. But the idea is that mutual funds don't give you much of a yield. If you invest in the Nifty 50, you might get maybe 2-3% in terms of dividend yield if you choose the dividend option. But for those looking for fixed income, some sort of income to subsist upon, this may not be the choice for you.
That is mutual funds. In terms of equity, let's talk about ITC.
Yes.
Which is good as an FD at the price point it was 2 years ago.
Yeah.
When we were at 150 rupees, 160 rupees, and they were giving a dividend yield of around 10%.
One point I just want to add to mutual funds is that there are some debt mutual funds which invest in bonds for you, and that gives you a higher yield. And there are mutual funds which invest in high yielding companies. So it takes a basket of the highest yielding companies in India and it puts money into them. So that may be an option for you, although we do not
advocate it.
Yeah, advocate any of it.
Yeah. And the other is picking companies, stock picking companies yourself, like ITC I was talking about. There are a lot of companies which are called dividend stocks, where they give handsome dividends to their investors on a yearly basis, but not offer much growth. These companies are also there, and you can invest in these companies where you get assured dividend yearly of XY percentage, but the growth in the company might not be spectacular as other equities are. So this is something to consider.
Yes.
This is how equity can offer you some kind of income as an investment, and on a yearly basis can offer you some support as income. The third one which we want to talk about is real estate.
Yes.
Real estate is also something which we in this channel do not really advocate, but it is an investment opportunity. Bought at the right time at the right price, it can yield very handsome returns. But currently, unfortunately, the market is not at the place where it is prudent to invest in real estate.
Yeah.
So I thought Sashwath can explain how real estate investment works and why it's not prudent now.
The thing with real estate is that you want a good rental income from it. And if most people, when they buy a house, an extra house apart from the one they're living in, they're seeking to rent it out to someone. And the idea is that you want to be able to subsist your EMI on the rental income. If the rental income I'm getting from the property which I've paid money and borrowed money to buy, if the EMI is greater than the rental income, then it doesn't make sense for me to buy that property, because to own that asset, it's going out of my pocket. Whereas if there is an opportunity for you where you're able to have the rental income match the EMI, then it may be something you can consider. Although we haven't seen those many opportunities. And if you do see such an opportunity with no other caveats, then that may be something you want to consider. And also the thing with real estate is there's a lot of paperwork. And there's a lot of, you'll need someone to consult with taxes on, and you need someone to figure out whether the paperwork is good and fine and dandy. So there's a lot of effort and a lot of costs which goes into real estate, and a lot of hidden fees and costs which you have to pay in terms of licenses as well. So real estate is something which can get very messy very fast for most people who are looking to invest part-time. And on top of which, our motto is not to borrow to invest. We don't like borrowing. We do not encourage our viewers to borrow. So if borrowing is one of the primary ways to invest, that's always something which we're very careful about. And real estate investing does require borrowing. And moreover, there's a lot of calculations and there's a lot of work which goes into real estate investing. It's not a large sum of money. It's not something which you can just wave your hand and get it done in a day or two, like it is to do an SIP. An SIP, you can just put 5,000 rupees to 20,000 rupees per month and close your eyes and it will be done automatically. It's not something you have to think about. But real estate is something you definitely have to think about. There's a lot of groundwork which you have to do. And for people who don't have that sort of time, for doctors and your lawyers and your other professionals who work from 9 to 5 and even later than that, they do not have the time to do this, and this may not be something which they should look into, especially because of the prices in the real estate market right now.
Yes. Another thing, since you're talking about real estate, is REITs. I thought Sashwath can explain what REITs are and how, if you are really keen on real estate, maybe this is something you can look at, and how the returns work in REITs.
So with REITs, or REITs, real estate investment trusts, as it expands, the idea with real estate investment trusts is most people don't have enough money to buy a full-fledged property out the bat. So what you can do is, some smart people have come up with an idea for it. They've said that, okay, we realize that most people who want to have that asset class in their portfolio to diversify their risk aren't given that chance because they don't have that amount of money. So what they said was, what if we take 100 of those people or 1,000 of those people, take all their 1,000 rupees or their 10,000 rupees, let's pool it together and buy a property or a few properties. And then let's professionally manage these properties. Let's lend it out, lease it out, and let's take this rental income which comes from it and distribute it equally,
Depends on your units, yeah.
Exactly, on how many units of the fund you own. So it's a lot like a mutual fund. So a lot of people come together, pool their money and buy certain properties. You lend it out, rent it out, and then you take the rental income minus the costs of management, and then you divide it amongst the people. And it's professionally managed. You do not have to get your hands dirty with this. And there'll be someone looking into tenants who come in, and all the management which comes with owning a property, all of that goes out of the window. You just works like an SIP. You put some money into it, and that's that. But there are risks. As with all investing classes, there are risks with REITs. When you buy a property by yourself, you know which property you're buying. With a REIT, it's not very transparent a lot of the time as to what property these guys own. And you don't know whether this rental income is going to be there for a long time. And if the property market goes down, you don't know what kind of returns you're going to get on it. It's not the same as a bond. A lot of people say that bonds and REITs are very similar. They're not similar at all. REITs are very volatile in terms of the return they give, and it's not an assured income which they're guaranteeing you. They're only saying, we will take your money, we'll try to get as much money out of it, and we'll only invest in real estate, and how much of a return, we'll give it to you fair and square. So there are risks involved, but it may be a better opportunity for those who don't have the money or the time to invest in an actual property themselves.
Correct. And like he said, bond is under RBI mandate. RBI is on top of it. It's kept a purview over it. In terms of real estate REITs, there's nobody there. And you have to completely rely on the promoter. You trust the promoter. He can be doing all kinds of jugglery inside the company and you won't even know about it. And he can move properties in and out of names, out of the company's name, and move it somewhere else and bring in something else. So these kind of things is extremely risky. If you trust the promoter and you have some kind of faith in him or her, this is something you can explore.
And REITs in India haven't been such a big prevalent thing so far. A lot of it started during the COVID financial boom, when a lot of money was being printed. A lot of the US financial innovations were brought into India. So you had the Happy Minds, this thing which came in. So the idea with REITs is that India hasn't developed as a market as such to have so many options. You, as an investor and someone who is a rational investor, you want a buffet of options. You don't want someone to point at a menu and tell you this is what you can have. You want them to give you the menu and say, have whatever you want. And in the US, you have the liberty with BlackRock REITs and you have Fidelity REITs, and here you don't have that kind of option. No. So maybe this may not be a viable option so far. Maybe in the coming years, you might have more options.
Another exotic thing which is there is something known as invoice discounting. I thought I'll let Sashwath explain what invoice discounting and how it works.
So invoice discounting is very similar to debt factoring. So the idea with invoice discounting is, let's say I am in business with my uncle right now, and I have bought goods worth 200 rupees from him, or let's say 100 rupees from him, and now this is a receivable for him. He gets to collect this 100 rupees from me at a particular given time. But now what he does is he wants the money right now. So what he says is he goes to this third party, person C, and he tells person C that I'll give you this receivables which you can collect for 100 rupees for 80 rupees. You swallow the 20 rupees for giving me the money immediately. So this is a certain commission which he is paying person C for the immediate cash. let's say because he needs the cash for some reason, or he doesn't believe in me paying back the money, and it's a very risky opportunity, it's something he can do. And so invoice discounting, what ends up happening is you become person C. You're saying that I will buy this receivable worth 100 rupees for 80 rupees. I'll give you the 80 rupees now, but I have the right to take the 100 rupees later on. So there's a 20 rupee margin you're making on this.
Right.
And invoice discounting, because of its risky nature, also has a higher return which you get from it. That being said, it is extremely risky because you do not know whether the invoice is going to be paid or not.
Correct.
And there's no particular mandate or something which guarantees that someone doesn't go bankrupt. So it's very possible that the guy who wrote up the invoices goes bankrupt and you lose all your money, and
Correct.
you're left with a piece of paper and nothing else.
Correct. And in India, the legal systems are such that everything takes time. So even your legal options, though they say you have legal options are a nightmare in India. So I wouldn't advise it unless you know person A, person B, and you know everything in the equation, and you know material, what is happening in the market, you have purview to it, and you're very wise to it. Sure, it's something, let's say you're doing it, you're a trader, and it's in your trading wheelhouse, sure, you can look at it. But if you're an XYZ person, you know nothing about it, I would strongly advise you not to go into it. That being said, we have covered 5 different ways you can generate income from your investment. So this is an investment which gives you some kind of returns on a monthly or an annual basis. So it's an investment which supports you on a daily or a yearly basis. So these are other options which we can look at. If you are someone who needs your investment to start working right now, and you don't want to wait, like how we usually say, wait till you're 50, wait till you're 60, we're long-term investors, value investors. You are not a Warren Buffett and you want to eat right now. These are some opportunities we thought we'll share with you. I hope you enjoyed this video today. If you did, please share and like it, and share it with your friends and your family whom you think would be interested in our content. Please do turn on the bell notification icon so every time we come out with a new video, you're aware of it. We'd like to thank you again for joining us today on Be Rich.
And disclosure that we are not SEBI registered advisors, and none of this is financial advice. We're just talking about some information which we've come across which we think would be interesting to you. Thank you.
Thank you.
I will be in Kuala Lumpur, Malaysia on the 11th of June this year. That is a Sunday. I want to meet you guys at Sheraton Imperial Hotel between 4 p.m. and 7 p.m. on that day. The Sheraton Imperial Hotel is in Jalan Sultan Ismail area near Quill City Mall. The Kuala Lumpur monorail railway station is available nearby. You can meet me there. For further details, you can contact us on the WhatsApp number below or send us an email at the email given below. My team will contact you at the earliest. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.